Good afternoon, everyone. This is Chrissy from Solstice ATR and Vulcan Capital Research. Hope everybody's doing great on this weekend. It's a Saturday. If you like us, subscribe. Hit the subscribe button on YouTube. It's a free weekly video. First of all, before I do start, we are at Solstice ATR. We're powered by Vulcan. My handle on Twitter is Chrissy Farah, and my handle on Discord is ZOU number 9345. What I have up here is the S&P 500, the Nasdaq, the Russell, and the Dow Jones Industrial Average. We are still in an uptrend, even due to the fact that small little correction we had in the last week and a half coming back down. So, before I do, I'm going to talk about PE ratios. I'm going to talk about the overall market, and at the same time about the COVID-19 and what the Federal Reserve has done in order to keep this market trending higher. And we have around the corner after summer in November the elections. I don't like to go into politics, but I want you to understand, trade what you see, not what you think. It's very important. Most people, they get emotional or attached to a stock or an equity or a future or an option, and they trade according to what the news is out there in the market. What's out there in the market is not the same as a human reaction and what the market gives us on the chart. So, as an overall, we can see we had this big move, in March till April. Then we eventually U-turned on most of the instrument. We are still in an up channel. We had the channel down here. I readjusted them just to show you on the daily how we are still trending in an uptrend on those four instruments. I'm going to go to the daily to show you how they look like. As you can see, it shows that we are in an uptrend. We are continuing higher. We had a small reset. We went up in the last 2 days. On Thursday and Friday, we sold off from the high. We are a little bit under. We're going to keep an eye on the channel, the 200 SMA, the 116, and the 50 SMA to keep us intact to the uptrend. First of all, let's break down the Nasdaq NDX. You can see we had a small minor reset. Most of the instruments in the Nasdaq were 100. We are still uptrending. We had the Friday basically sell-off, but if I can zoom in this area, you can see that we are still in an uptrend. We have not failed the 9,000 area. Another thing is the 98.50 area is going to be very critical on the daily chart. We do have the 18 simple moving average around the 97.65. We're still uptrending. We retested it not more than once, twice, 3 times, 4 times, 5 times, and we continued higher. If this time we lose it, I would look for the 50 SMA. Is the trend still in an uptrend? Yes, but since we had a prior high, we couldn't get a higher high on the Nasdaq. Watch if we lose this, major channel down here. We can draw a channel. I'll put that on there. We grab this, connect this one to here, and you can see this was basically almost identical. I mean, we can just basically look at it as, okay, this is what we can do. If this channel is tested, we get a bounce, that's great. If not, look for the 50 and the 18 simple moving average in the Nasdaq 100. Let's take a look at now small cap, RUT. If you notice on the daily, we fell down. We came back up. We're still in an uptrend. I can take this level here, connect it to here. Still, we are in an uptrend, but the Russell is a little bit weaker because if you consider this is the linear regression channel. This one and this one are basically parallel. We have lost it 50%, but we are still in an uptrend, continuing higher in the RUT. If we're going to lose this, we're going to come back to the 50 simple moving average and the 38.2 to catch our breath to continue higher. The Russell had created a higher low from the prior higher high, and we created a higher low from the prior low here. So if this trend's going to change, we got to hit here in order to continue to get to the 50, then bounce back up. Just keep an eye on the Russell. This is the weak link in the market. It was basically more or less of a neutral day in the Russell. Nothing major happened. Let's take a look at the dollar sign DJI. And if you notice in the dollar sign DJI, I'm going to just zoom down a little bit so we can get a better feel. This is the high, this is the low, and we continued in an uptrend. So what we can do is zoom in and connect those two dots to see if we are still in an uptrend coming up on the Dow Jones Industrial Average. As long as we don't lose this channel in the 50 SMA, this is going to be very critical because the Dow is a little bit more weak. It continued that was the Tuesday. This is Wednesday, Thursday, and Friday. It was inside the range and eventually came in. As long as we don't lose the 116 SMA, the 50 should catch us nicely to go back up, unless things do change. Let's take a look at the SPX. And let's zoom down. Where is it? And we noticed that the SPX hasn't filled all the gaps. We have a couple of minor gaps lower, and we are still in an uptrend. We retested it that last week, and if you notice on the daily chart, when we retested, we did that bounce down on Monday, pushed higher. We had Tuesday, Wednesday, Thursday, Friday inside the range. Unfortunately, Friday we sold the 30.62. This is going to be very critical. We are a little bit below the 18 simple moving average on the daily. This is a linear regression channel. We have potential either to lose the channel, continue to the 5200 and the 116 SMA to catch our breath, then continue higher. If we reverse and clear this tops, that top on this one was 31.53 and this was 31.55. In order for us to reverse, we have to clear 31.24 in order to continue higher back in the linear regression channel. So if we're going to look at it in a detail, what I want to do is do the volume profile here. We're going to go to time frame. In the style, go to monkey bars. And the monkey bars here, if you notice, this is a 15-day chart. So what I want to do, go to, instead of 15-day, go to time frame, go 10 days instead of 15-minute. We're going to create a 30-minute bar and push OK. What did we do here? OK. This shows, the higher high. We were consolidating in range. Then we looked below. Then we continued higher. This is Monday, Tuesday, Wednesday, Thursday, Friday. What I'd like to do is take the Monday low and the Thursday high, because this range was actually 3 days in range. The POCs were very similar, but the time spent was a little higher on sell-off every day during the week. So what I'll do, I'll take the Fibonacci. I'll look at the low here. What was the low here? 29.65.50. Close enough. And the high here was 31.55.50. A little bit more, a little tiny higher. Yeah, we just got it close enough on the anchor. If you notice, we are still above the 50% fib. If we're going to lose the 38.2 because the close was a little bit weaker on Friday, and we cannot come back above the 30.60 area because we sold off in the after hours, this is going to be very critical, and we lose the 30.38. Look for the 3,000 and the 29.65. If we can clear this area and come back to the 80, look for the 31.08, 31.05 in order to continue to 31.24, and this would be the critical area where I think the trend will change back to the upside. If we lose the 60 and we continue lower, keep an eye on the 38, 3,000 would be mental number 3006, and eventually the 29.98, the the 29.78, and eventually the 65. This is the reason why I put the Fibonacci here. If you notice, most of the POCs are in a similar range, except from the week before. I did not count that week when we looked up. Then we had the prior week, we fell down on Thursday and Friday. If this is similar situation to prior week, since we rejected, and while we're going to create a higher low from here, possibility. So that's why I put that chart up there. What I'm going to do, go to style, go in chart, go to standard, there. What we're going to do is go from the daily to the 4-hour, this area. And here are the scenarios once again. Since we retested that area here on Friday, if you notice, the looker down was to the 30.83, and we bounced back up and we closed around the 30.97. But if I show you this on an SPX, instead of using the SPX, we use the ES. This will give us a little bit better idea where we are. Let's go look at the ES. Here. A little bit. Okay, minimize it here. If you notice, this was the Monday low. We can take the overnight and measure it from here all the way to here at the 55. So I'll grab this area here to this area here. And if you notice, we have lost the 38. So I would keep an eye, since we lost the 60 area, this is very important for me in 68. In order to go back up, I need to get back to the 31.06 area in order to continue to the 31.24 in order to push higher. If I think that there's more weakness in the market, I look at the trend, the 50, the 200 SMA, 31.12, 30.06 should act as support, and if we end up losing it, we'll come back to the 30.83.85 in order to continue back higher in this upper linear channel. We have a symmetrical triangle between this channel here, and we have a minor one down here. So keep an eye on the trend for direction. What I'd like to do is basically come in and show you a couple of other things here, and I want to talk about the PE ratio and what the market can give us, okay? Actually I did some work over the weekend, and I'm looking at the S&P Shiller PE, or the K, from 1988 to 2020. You can read these things to tell you that from the 1991 till 2020, we had an average PE ratio of about 26. But if I look at the average rate of return compounding for every dollar that we spend, we have from 1881, this is not a bad print, I'm telling you, it's 1881 till 1990, the PE ratio was 14.71. We never had a PE ratio or negative PE throughout history. If we look at the overall from 1990 till 1991, we can see that the PE ratio was always moving higher by looking at the S&P 500. Remember, this is educational. We are not broker dealers. Past performance does not indicate future results, okay? So let's go to the next chart. I want you to slow down and read these. This is an example from 1960 to 1979. The PE ratio was about 16%. For every dollar we spend, we had an increase from that period from 1980 till 1991. People were spending, instead of the PE rate for each dollar they put away, it was about 18.3%. And after the Twin Tower, the 1999 collapse of the tech bubble, 2000 and 2001, our PE ratio had increased from this period to this period 42%, and our average PE was 26.1. If I look at it as an overall PE ratio, looking at the earnings of all the companies out there, and I do use the 10% average, and I use the average of the 16 all the way to 26, I'll show you the numbers here so you can get a better feel. The S&P basically acted as a 10%, a 42. If we use the average, which is the 26.1, and we only get a 10% increase average in the next 5 to 10 years, that is a 28% for each dollar that people do spend. If I use the average of the 10 and the 42 and I split them in half, the average is 32. But if I use from 1980 till 2019, this is an increase of 42. That would be 37 PE ratio. So if we even get a 26 minimum to a 37% increase, or if I use the maximum, we have a maximum PE ratio of a 10 since 1999 till 2020. Using those numbers here, it'll give us an 85% increase in overall market strength in the next 5, 10, 15 year down the line. So here are the scenarios looking at the 26 increasing at a 10%, increasing at an average between the 10 and the 42, 32, all the way to a maximum 48%. Even if we use a 26 or 32 PE ratio, we're going to average an 85 overall the market. And if you look at it here, this is taking the Dow Jones Industrial Average from 1965 till 2000, an average rate of return compounding rate. The S&P created an index of 582%, the Nasdaq 1,630, the Dow 574, because it's a more of a concentrated 30 companies in the US. And if I look at the ratio here from the 1987, 1990, all the way to up here, we had a major increase from the Nasdaq, the S&P, and the Dow, an average PE ratio of 44. Remember, this is a chart for educational use, not for basically predicting what the future outcome is. This is something that I'd like you to, that is concerns in the market. This is from the Wall Street Journal. The COVID-19 has increased in Arizona, hospitalization about 59% in emergency, and the beds are used about in the ICU 70% unused, okay? So here's the second one here. Valuation are relevant. Valuation helps us better understand risk and reward and opportunity cost proposition. So basically what I want you to understand, when there's weakness in the market, we want to buy the weakness and sell into strength, and do vice versa. When there is strength in the market, when it pushes too high, it gets too extended, we're going to basically do reversal. Don't evaluate yourself and cut yourself short in this market, because the market is not manipulated. Basically, the Federal Reserve Board is pumping money, the UK as well as the Australia, as well as Asia. Remember, what you see, trade what you see, not what you think. And here's another one: understanding that some measures in stock expensive relative to historical norms allows us to keep an open mind about worse than expected outcome. We have to always look for the worst, but at the same time understand where your risk management in a portfolio, and understanding where it can happen and what the changes in the outcome can come from it. Understanding multiples can expand over time, and stocks can remain overvalued. Because this is what people always say, the stocks are overvalued, such as Amazon, Google, Netflix, Tesla, for a very long period of time, because we cannot sustain and be liquid, because we are a small investor compared to the big sharks out there in the institution. Be open-minded about better than expected outcome over the next 1 to 5 years, okay? Remember, I did this a couple of weeks ago in the video, and I kept telling to everybody, we're going higher, we're going higher, we're going higher. Everybody looked at me like I'm a madman. So, just like charts, indicators, data set, evaluation cannot predict the future. They simply help us assess probability, which is true. More concerns and less concerns. What do I mean? In Texas, there was an increased spike in COVID-19, which is, people are going to call in a pandemic. while people are creating chaos over there. And hospitalization as well. So read this information and how much do we have unused. So, okay. So more as well in Texas, California, Georgia, Utah, Wisconsin, Florida, and nearly all states have amplified the hospital and the ICU capacity. Massachusetts, that's what they are predicting, had only 896 people pass away. In Los Angeles, the ICU utilizing has fallen by about 15% in the last month. Remember, what the news is giving you is fear, causing fear and greed and panic. Trade what the charts give you, not what you think, because it will keep you more fluid in the market and the outlook in trading technicals than trading something else. I hope this was helpful. So if the trend has changed and we're going to come back for a smaller reset, what I would look for is those first three levels that I showed you on the chart down here. Let's just zoom back down from here and we'll look at a little bit more detail. So we can go from 38 to 50%, 61, 78%, and eventually 100% retracement. If this channel is going to hold us, we get a bounce. If this channel is going to lose us, we come back to the prior high where we broke out, where we created the H pattern on the daily chart was 28, 55 area, 50 area. And what I want to do is show it back to you on the hourly chart. We'll zoom down. This is the H pattern that we created. And we can hold this position. If we don't hold that 55 area, we eventually can fall lower to about the backside of this channel where we can catch our breath and continue higher. So we're going to trade what we see, not what we think. I hope you enjoyed this video. Be safe out there. Look forward to seeing you on Discord or at Solstice ATR. Over and out.